Welcome, everyone, to another edition of the Industry and Transition Podcast. This is actually a very special edition. I mean, as you know, almost exclusively we interview CEOs of firms, but I recently read a great book about something that's sort of complicated and, find it to be fascinating on a whole bunch of levels. The Bernie Madoff story. And this book was called The Madoff Talks. There's a longer title. I'll let Jim talk about it. We have its author, Jim Campbell, here with us. Welcome, Jim.
Thank you, Tony. Good to be here. And I'm honored to be a CEO today for the show.
That's right. Well, what I took away from it just in reading it, that this is a tragedy of Shakespearean proportions. There's so many things, and the especially what you get into, a lot of is the impact on the family itself, which just feels terrible when you read it, because the whole thing is about betrayal. But what could be more of a betrayal than a father to his family, or husband to his wife? And another thing I took away was sort of these little lies, the fact that here was a guy who was able to sort of separate his personality into sort of different silos, and completely self-justify. Everybody rationalizes. You do it, and I do it, we all do it, but this guy did it on a massive scale, and just I have no idea what the psychological term might be, but it was just the whole thing was sad and tragic, and what's going on with the people that he took money from, as well as his family. And he's so pathetic.
I would say that term, by the way, was compartmentalization.
Yes.
When you can run one of the most ethical businesses on Wall Street side by side with the biggest criminal enterprise. And you're right describing the book. I would say the one other thing is what's very little understood is that he didn't really act alone. He was enabled by several different factors to be able to get away with this for 40 years.
Well, it's interesting. So, our audience is pretty sophisticated in financial stuff, but it's amazing how this is just a Wall Street thing. Like when you finally get to meet this guy who's this big hedge fund guy, he's having a beer and he's burping, and it's like, this is a regular guy. What is going on? What's going on here? And a lot of times when you get to the pinnacle of these very sophisticated trading strategies, people aren't doing the basic stuff. They're not asking questions. And this is not just investors. These are large investors who have hundreds of millions of dollars, or running hedge funds, and they just as soon look the other way. Ignorance is bliss with these people.
That's exactly right. I couldn't find any of the victims or even the sophisticated traders on his legitimate floor that could explain what the split strike conversion strategy was. And Bernie would explain it to me, and it'd be opaque, it'd be hard to understand, I'd have him repeat it. But eventually I figured out this is really conceptually easy, and obviously couldn't do what he said it was could do. Basically, he had a strategy that mirrored the market. So therefore, it should have been 95% correlated. Well, right off the bat, anything that's that highly correlated to the market can't guarantee results.
Right.
It's going to go up, it's going to go down. He had a strategy that was that simple to understand. Nobody understood it, and it couldn't do what he said it would do.
And just a few people over the course of years kind of just figured that out. Other people were dazzled by the feeling of success. In our business, you probably don't know too much about the retail business. People love success, right? It's all about success, and it doesn't have so much to do with money, although it has a lot to do with money. But you admire people who have sort of made things happen. We all work with business leaders, guys who have sold their businesses for tens of millions of dollars. There's a dazzling aura around people who are successful that sort of you could be easily misled by it. And as you said, which is unusual, he had a legitimately successful business. He actually did, helped invent the NASDAQ exchange. I mean, a lot of the stuff he did was really helped a lot of small to medium-sized investors in the long run, right? He made things more equitable. He made trades more equitable. He did all that. And the crazy question is, why do the other?
Yeah. Not only did he have a legitimate business, it was worth $3 billion at peak. And what you describe is exactly right. He actually built innovative systems that guaranteed his customers got best price execution, and even above what was publicly quoted. And he would not allow, and he built systems to prevent front running, which is what everybody thought he was doing. And so when you think about building this, how could he at the same time build this thing that was completely defrauding, was completely fake, had no trading?
But I guess the question is why? I mean, we saw how he did it, right? You in the book, you go into pretty good detail about, how he did it. And I guess the $64 billion question is the why. I mean, why, if you had this successful business, and do you think it's because it was propped up by illegal trades, or it wasn't quite, or he couldn't get out of it once he started?
Yeah, once I figured out, see, the logic is that he's running this great honest business. He hits a bad trade, loses some money, and I'm going to make the classic gambler's mistake. I'll double down, we'll get it back, and no one will ever know. And that's what he told me. He had not told anybody else. He hadn't even told his lawyer that story. But when I found out that that wasn't true, that he'd actually been building these side by side, there has to be a deeper reason why. And the only thing I could come up with was the market making business perfectly fit his psychology on that side of the compartment. Innovative, cost control, market up, market down, I'm making commissions, okay? He goes over here, he starts off with 24 friends and family. He's gonna do a little money management. Oh my God, I can lose money on trades. He could not physically or psychically stand losses. So what did he do? Did he shut it down? No, he just faked it and stopped trading and always showed gains. He just couldn't do it. And that's why he did it at the same time. And how you have that kind of a brain split, I don't know.
Well, it's not only that. I mean, it's like a stupid criminal enterprise. I mean, had he spent as much time, I mean, just on a relative basis to him, not talking about the managing 64 billion, but he could have had a business worth $3 billion. He could have walked away with $3 billion, right? That thing's not only saleable, but as you point out, it became unsaleable. He couldn't sell it because if you sell it, you got to go over the books, and it would never would have, worked. But that's, in my mind, the craziest part of this, that he could have had this legitimate thing that would have been extremely lucrative. Maybe would have made him richer than he ended up, being with the Ponzi.
Yeah, his family could not understand why he didn't sell out. At that time, Goldman bought Spear Leads. Those were specialist market making firms, so the price was completely established. Spear Kellogg actually was twice the size of Bernie. So it was $3 billion that he was going to be worth. And the families couldn't understand why he wasn't doing it. But because he put the investment advisory under the same umbrella instead of a separate corporate entity, the due diligence would have had to include that. And obviously, he couldn't open the door to the 17th floor when he didn't even show it to his own family.
Yeah, well, that was, again, part of the stupidity. A smart guy that could sit and grow, it's like he's compartmentalized, but one compartment's stupid. The criminal compartment was kind of dumb. He perpetrated this fraud, right? And in a lot of ways, he wasn't super smart. People around him were dumb. I mean, the SEC, all these other people were dumb. And so, just a few questions probably could have pierced that balloon pretty, quickly. But he was so smart on the legitimate side. It almost feels like he wanted to get caught on some level, with the other, but no one ever challenged him on it.
Those are great points. This thing could have been solved in 5 minutes in at least 3 ways that I could come up with, and that's just within minutes. But without his big four investors who extorted him because they bailed him out, the biggest of whom took $7 billion out of the fund, 9 times more than the actual wizard Bernie did. SEC missed him 5 times. The feeder funds looked the other way. They obviously knew something was wrong because Bernie wouldn't let them do due diligence. So, and then on the 17th floor, exactly right, he had stupid people, high school graduates, unsophisticated, didn't understand Wall Street, thought backdating trades was, nothing wrong with that. And he needed all of that to get away with it for 40 years.
So in terms of how this thing ended up playing out and who suffered and not suffered, what was just go into a little bit who the big four, feeder funds were, their complicity, and what happened to them. And then I want to talk a little bit about the regular Joes who, were in the 17th floor office.
Yeah, on an overall basis, it was 64.8 billion that their final statements should have added to. They had put in 19.5 billion, so that difference was what was lost. The big four, they had to give back big chunk of their money. Actually, Pickauer had to give back the $7 billion because Bernie knew he had other money at Goldman Sachs. They were only going to go after $2.5 billion. The feeder funds combined about 18 of the $1 billion of folks that were within them, and they got clawbacks. Nobody though on the feeder fund side, the bank, which also
So on the feeder funds. So it was for the hedge fund managers had the clawback. The underlying individual clients, I'm assuming
they got wiped out. Yeah.
Start again. All right. So the underlying individual clients they weren't clawback from them. It was clawback from the money manager, the hedge fund.
Well, no, yeah. The way it was defined actually was by investor, which would have been a feeder fund class, but the individual investors, right? If you withdrew more than you'd put in, you were subject to a clawback. If you'd left more than you'd taken out, you were subject to getting that. But now think about this though. Think about this. This is what upsets me about this. The SIPC had the duty, it's like the FDIC, to make people whole. They finagle their way to sidestep it and put it onto the Madoff victims, what I call a reverse Ponzi scheme, taking from one Madoff and giving to another, because they happen to be net winners, even though they knew nothing, the innocent guys now. Now, some of the feeder fund guys that were willfully blind, they should have probably gone to jail. But it was just as big a scandal in my mind, SIPC. They also had no real money on hand. They were told 16 years before by the GAO they were inadequately prepared for a major brokerage crash, and Bernie's was only 230 people.
Yeah, they I didn't know that at all, that with these clawbacks that they're going after. You just assumed, oh good, go get the bad guys, but these are people that were completely innocent. And I imagine you would have spent that money already, or you would, how do you get it back? Now you're forced to sell your home, and you're forced, I mean, that doesn't seem like they're getting proceeds of illegal activity. Don't you have to be a participant in illegal activity to get receive a proceed?
It's to me, it's not only an unheralded scandal, but think about this also for the industry. SIPC represents confidence in the industry, right? Like the FDIC does. So first off, they tell you, well, maybe your statement isn't final, and we're not going to honor it, because they didn't honor the final statements. Oh, and by the way, we might come after you through no fault of your own. The clawback money, you may not even have anymore. You took it out, you may have spent it. I can tell you, Ike Sorkin, who was Madoff's lawyer, his sons lost $900,000 with Madoff. That money wasn't even at Madoff when they clawed it back. It was at Merrill Lynch by then, and they gave it back. Yeah.
Again, that's a story just never heard of. No one ever talks about it, about it. But I'm sure everyone has a collective guilt, feels bad for you hope that it goes to the people who need it, who maybe have absolutely nothing, because of it. I mean, he took money from charities, and there was no moral compass there.
No moral compass at all. In fact, he'd go to the charities and he'd say, here's $250,000. Oh, by the way, you don't know what to do with all this money? I'll manage it for free. Bring it in and disappear it.
Jeez. And then pass it along through these other entities, the big four entities, and let them.
Yes, that was what I call the reverse Robin Hood, because he took money from his average net worth investors and funneled it to the richer ones by giving them a lower return that was fake and giving the higher return that was faker, 40%, 30% down versus 10 to 15%. That's what he was doing.
Unbelievable. So obviously the other component of the tragic aspect of this, and we just know more about them. You talk more about them in the book. I mean, there's a lot of these sort of, not that they're anonymous, you do go through who some of the individual investors are, but everybody kind of knows the family members and the absolutely tragic results that happened once he talked about it.
Yeah, the average age was 75, which is a tough time to go back and have to get a job. There were 80-year-old guys who went to work at Walmart, all the way to the extreme of the British Army war hero. He'd fought in every war Britain had fought in from the 70s through 2008. He had put all his money with Bernie. 3 weeks after he retired from the Army, Bernie went down. A month later, he shot himself in a London park.
Yeah. Well, then his son kills himself too. So his own family.
The son killed himself 2 years to the day that Bernie was arrested. Also 2 years to the day when Eleanor Squilleri, who was the honest secretary on the honest floor's daughter, who had worked with Mark as an intern when they were teenagers in Bernie's firm, called to say, on that day, Mark is not going to be able to handle it. He's going to kill himself. And he did exactly that.
Terrible. And then his other son dies of cancer. I mean, there's nobody left. And Ruth is gone now too, correct? Or she's still
Andrew died in 2014, as he told me. He killed my brother quickly. He killed me slowly. Ruth moved to Old Greenwich, Connecticut from Florida. She was living with her sister, who Bernie wiped out, by the way. They're now driving an airport limo to survive. And that's how she and I met. She's still here in Old Greenwich, basically the only surviving member of the family.
Oh, geez. And it's a terrible, it's just a terrible tragedy. We revisited on those people by this guy who just didn't care. Just didn't care at all. He
had a problem with showing remorse, put it this way, as I tell people, it kind of stuns them. He felt that he was the one that was the victim of relentless, greedy investors who would only allow him to deliver, even though Bernie set up all the terms, the fake returns, the bribing, essentially passing back the asset management fees to the feeder funds. Go figure.
You see this again, this compartmentalization and self-justification in the mafia too. That what's so engaging to people about something like The Sopranos or one of these mafia shows is they try to live a normal American life, and behind the scenes they're doing terrible things. Like Tony wants to play on a golf course with the doctors and everything, but he's whacking guys in the back. There seems to be that same dichotomy here. He wanted to present a certain way.
Absolutely. He was more concerned above anything related to greed with his reputation, and that legitimate firm, no matter what happened, had to be considered legitimate, and the regulators had to view him as an industry leader in ethics and everything. And that's why he ended up pumping $800 million back door of the market making firm, because he had to keep it solvent.
So the legitimate business, you think, would have lost money had not, or would have maybe gone out of business?
The legitimate business would have been insolvent as early as 2001. And it's because largely, first off, decimalization came, which shrunk the margins in his market making business. But the other piece of it was,
there was still profitable market making.
Exactly. The market making, the trading in the market making business alone, and again, you were saying if he'd stuck to his knitting, it was always profitable. It was doing well. What happened was the firm got bloated. They were using it as a piggy bank. He couldn't fire people. He was giving bonuses to traders, still losing money, and there was too much overhead. And basically, he was keeping it alive by doing it that way, and carrying family members who weren't really were ghost employees. But the market making business itself was always profitable, and more profitable each year from 2001 to 2008.
And the other thing that struck me from your reading the book was that he was taking in new assets, like from like the day before, the week before, before he went and confessed. I mean, he must have known at that time that this is it, right? Or he did know, because he had a trade. He knew he had a big redemption coming, and he knew that redemption was going to expose everything, right? And yes, between knowing about the redemption and going to the feds or whatever, or his son's turning him in, he still continued to take assets into the Ponzi.
He took assets into the Ponzi the day before it went down. Even that firm that he was going to rip off from the redemption was an optimal European hedge fund, 250 million he was going to default on. At Thanksgiving, he was trying to get more money out of them.
Unbelievable. I mean, to buy a few days. I mean, what was the point? I don't.
You know what he wanted?
I'll ask you at that point. What's the point? I mean, he knew this was coming, right? So he knows there's the end. You describe him in the book as sort of laying on the floor in his arm. I mean, like, he was he was broken down, a broken man. Like he had hit a wall somewhere, and everyone around knew something was wrong, but they didn't know what it was, right? Maybe it's a personal thing. So he hits this wall, but during that time, he continues to do evil deeds. I mean, what? Why?
This is
I
an
mean, he
example,
knew it
by
was
the
it.
example, by the way, about he's not just a black and white sociopath, because one of the reasons he picked that date was right near Christmas. They wouldn't notice it was defaulted until maybe after Christmas, and that was going to get his employees through Christmas. He wanted to do that. He was trying to hand out bonuses, and there were about 270 million that left. 7 billion had been withdrawn during that year. So that was the last money he had, and he was going to dole it out to friends and family and to employees or whatever he could do in that last bit. And he couldn't turn himself in again. He could never admit failure. So he was supposed, the plan was wait till that period. It'll get us through Christmas. I will have confessed to my family, and Ike Sorkin, my lawyer, would tell me how to turn myself in. And he panicked, as you know, on December 10th, and his lawyer didn't know what he did until he was arrested. And after he hung up, he still didn't know what Bernie had been arrested for.
He just said, "Don't say anything."
He said, I'm handcuffed to a chair here with the FBI. And then Ike got on and said, no more questions. And then he hung up. He didn't know what the hell Bernie had done to get arrested.
Jeez. But it was too late, right? He had already confessed.
That's exactly right. He found out that Bernie had completely confessed. So, you know, I could have drawn it out, but yeah, it was taken out of his hands.
Well, the other piece of it is, you know, from our point of view in the business here, is not just the SIPC, but the regulatory, you know, agencies. And, you know, the Bernie thing tainted all of us, everyone who works in the securities business, you know, 99.9% of whom are, you know, really good at their jobs. They care about their clients. I mean, I've been involved in the crashes and stuff, managed people, brokers in my office, you know, in tears. Can they help their clients? You know, you can't pay your clients back for losses, but advisors would have done anything to help. You know, my client's going to lose a house, and, you know, I recommended this thing, and now, you know, it's all of a sudden not backed anymore. What do we do? I mean, that's my experience with financial advisors. Really good people who really feel every day for their clients, you know. But it's this kind of stuff that makes everybody look bad.
Yeah, and you know, most of these folks are really good people, because if you put your clients first, you're going to be successful and you're going to make money. And Bernie proved that in the legitimate business, you know. And this kind of thing is really leaves a black eye. And you know, the underlying thing was nobody understood what the heck he was doing. And hopefully your advisors are explaining to you where they put the money and how it's being how the income is being generated, and does it match the client's risk profiles.
There's mortgage-backed securities, you know, there's auction rate securities that we can look at that happened back in the days when nobody really truly fully understood what they were selling. We were told sort of I don't want to say it was glib, but you were told this, hey, this tranche is a little more risky and here's your percentages. But no one who sold that, no advisor who sold that knew exactly what it was made up of, that these things had a potential to go to zero. You just thought, well, there's a house backing it, right? Or somewhere there's something like that back. There's got to be backing somewhere. And we sold that stuff, you know, anyway.
Yeah, you know, the hedge funds, the advisors, all these guys have to do their due diligence. Due diligence, in my mind, should be a requirement that is delineated, just like FASB has accounting rules for the accounting industry. Right now, due diligence means nothing. It can mean nothing. It can be just marketing stuff. And you'd be amazed how many people just accept word of mouth or affinity. And I interviewed a guy this week, 23-year hedge fund manager. I know him, one of the most honest guys I've ever met. He had 80 high net worth clients over 20 years. One of them asked him what his strategy was.
Yeah. Well, I guess that's not, you do so much of this on trust, and that's why, you know, in
exactly
all business, right. On this side, it's based on trust, and you meet people and they, you know, they develop a rapport, and you try to figure out, you know, best ways to help them. And that's why, you know, most advisors will limit something like a hedge fund or unusual to a small percentage of a wealthy person's portfolio, you know, so people aren't stretched. The other thing that struck me was how many people, and it had to only be because of greed, were all in with Bernie. A lot of these, if you're a fund to fund manager, the whole point of being fund to fund is that you have multiple funds.
Exactly right.
Means, right?
Yeah.
So, but you're telling me these fund to fund guys put 100% of their fund in Bernie. because they got a kickback, correct?
Yes. Not only did they put 100% with Bernie, a lot of times they didn't tell them the money was with Bernie. And some of them misrepresented what Bernie's strategy was, not even trying to sell the split strike conversion strategy. And yes, what Bernie did was pass back all of the asset management and the 20%, the 2 and 20 he passed back. Now, by the way, any hedge fund guy should be asking, why is he giving me that? Right off the bat. It's hard to turn it down, I admit, but why would anybody in his right mind pass that back? And of course, what Bernie was trying to do was say, I'm just taking execution trade commissions. So it looked like he wasn't doing any asset management. But it's incumbent on the hedge fund guys to actually, take that red flag and not put it in their own piggy bank.
So that's interesting. So he said his investment business was really a trading business.
That's what he tried to follow. Remember, he never registered in the ADV form that says you're an investment advisor. He didn't do that till 2006, right? So he would actually, for Fairfield Greenwich was the biggest feeder fund. He would actually script them to say, Bernie executes our trades. He's got 40 years of market making experience, and he's got Chinese walls up, and it's very protected. We don't want to use the term investment advisor. We don't want to even use the term consistent gains, because he knew there wasn't enough volatility being shown. And these guys who were actually really well-credentialed risk management people were writing it down and spouting it exactly word for word back.
In your mind, now having studied this, there's two questions. One is, what was the most egregious of the sins? And it doesn't have to be Bernie, it could be, but it could be, who was the most egregious sinner in this? Who was the one that was it the people who should have been looking after it? Was it him? Was it these guys in these feeder funds that sort of were complicit in it in some way, but they didn't, I don't know if that's been proven or not. But let's start with that. Who in your mind is most?
Yeah, I don't know if I'd use the word sinner, but to me, it's that the system enabled him. And you remember, these poor investors assume that the SEC is a cop, which it's not. It comes in afterwards and cleans up the mess. And they also think, well, there's 5 investigations, so this guy's got the housekeeping seal of approval. 5 times they've exonerated him. They didn't know they was investing the same wrong thing, chasing the wrong rabbit, right? And the feeder funds represent that they're doing due diligence, right? That's their value added. They're supposed to earn a % for that, not the entire management fee specter. And even if they didn't know it was a Ponzi scheme, which they didn't, they knew Bernie was lying. They knew that he wasn't allowing any due diligence. They couldn't do their fundamental job, right? The big 4, for them, it was a giant fraudulent tax evasion scheme, right? They call in their phony gains, they pocket the money, take it out of the account, and then call back 6 months later and get a capital loss to cover the gains, and they never got nailed for that. SIPC, we've talked about, basically didn't honor their mission, much less that there was not, that they went after Madoff victims themselves. Ponzi schemes are easy to detect, and they by definition cannot survive. This one should never have survived for 40 years without the system enabling it. And we hadn't even talked about JP Morgan, which had the only view into where was the money and how much was there.
Yeah, I mean, that's the whole thing. Big banks, and they were big, high-end clients in the legitimate business side, from the Schwabs and the Vanguards.
Let me tell you something. I talked to the then president of Schwab, a guy named David Patrick. He told me that they thought Bernie was great. They trusted him. They ran a great, clean business, and they basically took over the back office for Schwab, right? They did all the trading. They got the customers the best prices. They allowed Schwab to advertise, we're going to consummate your trades while you're on the phone with us. And Bernie used to love to deal with them. He hated dealing with the hedge fund guys downstairs.
Well, that's another psychological cue right there. Right. Part of him knew that was wrong. So the system seems to be the very culpable here, right? One of the needs to be. And as far as tragedy goes, I think it's pretty hard to say that Bernie's a tragic figure because certainly doesn't seem like the good outweighs, the bad there. But who would you say is the biggest tragic figure in the entire play?
I like to say that the victims, because the victims had to become survivors first off. The victims thought that the system would be there, and it wasn't. They thought that they didn't realize that the SIPC trustee would end up going after them if they'd happened to have been a net winner. So they were brutalized multiple times. Now there's the suicides and things like that. There's having to go back to work with no money. There's people that saved for 40 years. One, Ronnie Sue Ambrosino, her husband was a guard at the Rikers Island. Their whole plan was save all this money, get a motorhome, and we're going to travel the whole country. And it got blown up right before that happened. So I see that the family's a tragedy in the sense that the sons believed in him. They were at the, you talk about the mafia. It was like a restaurant. They were at the front of the restaurant every day protecting that firm, and all the bad stuff was going on in the basement 2 floors down. And it's a betrayal of Shakespearean proportions, but I can't put it on the same line as the victims. That's the only thing.
Yeah. Well, everyone was lied to. You learn more about the family, and just have your father do that to you. That kind of thing just seems really bad, to me as well. Look, this is a fascinating topic, and to a great extent, the government is making, and in our business, they're making an effort. You know what I mean? You look at the SEC, there are new rules like, Regulation BI that are really trying to get advisors to be, fiduciaries. I think some of the stuff they're doing, and so you see some of these 401k accounts going to a different degree. They won't allow people to invest in hedge funds and things like that, which limits their participation in legitimately good market returns. So somewhere there's a balance, but I think they're trying to address this stuff now, and this was pointed out. And
let me say that in behalf of the SEC, that they have become very good apparently at detecting Ponzi schemes. They got about a 90% chance of knocking you down unless you're offshore, and then they might miss you. They're not yet a proactive protecting cop, but they're better, and they're shorthanded. They need more examiners. And a point you made there too, I think it's important. It's important to have the right incentives for good behavior. It's not right to put on burdensome, excessive regulations. I always say Senator Warren, for instance, doesn't understand Wall Street behavior. Wall Street folks behave how they're compensated. So you need to penalize them and disincentivize them from doing bad things. But wrapping them up in a lot of regulations is not necessarily going to work, and it's going to hurt the industry.
Well, and ultimately shareholders and the widows and orphans and all that we're supposed to be working with on a regular basis. So, hey, this is fascinating. Jim, we could do this again, and hopefully we'll talk more. But the book is Madoff Talks. What's the long title?
Uncovering the untold story behind the most notorious Ponzi scheme in history, from McGraw-Hill, Amazon, Barnes & Noble, Walmart, and independent bookstores if you want to support them.
Yeah, it's a really good read, and it's fascinating. And it's also it's gut-wrenching at points, because you feel for everybody in it. So just no winners in a situation like that. Jim,
Tony, I appreciate it very much, and all the good work you do for the advisors and everything. It's very impressive stuff. I can't wait to come back.
Great, thanks a lot. Good talking to you, Jim.
Take care.